Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark puts perspective on this week's markets. How can we fire up Canada's struggling junior mining companies? John Kaiser of Kaiser Research has suggestions. And did we see panic selling this week? Wall Street Window's Mike Swanson comments on that. We talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor for CIBC Wood Gundy. Welcome to This Week in Money, Ross.
And it's always a pleasure to be back with you, Jim.
After a long slide, it looks like the Canadian dollar has finally had a nice bump up.
Well, currency action pretty big this week, and it's amazing how the pieces sometimes fit together. This was one of those weeks. For all that we got some good employment numbers, had a really good pop on the upside, up about 70 points, one of the best days that it's had in weeks and weeks. It's interesting in terms of the timing of it. It was as much a move in the U.S. dollar as it was a move in the Canadian dollar. And, we talked, I like to put all the pieces together in terms of the currencies, the metals, and what's happening on the equity market. And from the modeling, looking at this U.S. dollar base that we're coming out of, it was 5 years or so in length, and so similar to the one that we had in 1997 on the breakout and back in 1981. These long-term patterns, as you come out of the bottoms, there's some action which is fairly consistent. It's going to have some little nuances to it, but there are some fairly good patterns that show up. And that the first breakout in the U.S. dollar in that 12-week run into the first part of October had a 3-week correction in what's normally a 2 to 6 weeker, rallied to new highs in this last week, and typically you'll get that surge into a new high, and now we will get the broader, deeper correction for the U.S. dollar. So that's, in terms of my modeling, what we would be looking for. The U.S. dollar has turned as of the tail end of this week. Looks as though the index, which is around 85 or 87.5 right now, could correct back down to about 85, the same level that it was in the early part of October. And as part of that turn, what you got was the reversal in the Canadian dollar to the upside, 70 points. Employment numbers in Canada, second really good month in a row, 6.5% rate there. U.S. employment numbers not bad, and the other aspect from the currency perspective, with the U.S. dollar, with it making the turn, is what we've seen in the metals market. And as of Thursday's close, my technical work, which looks, I look at trends and I look at exhaustion points in trends when markets have just become excessive, in the case of being trending and getting to that point where there's an urgency on the part of speculators to get in or out. And what we saw in the silver market into Thursday's close is one of those rare events that jumps out for me. It's what I call a capitulation. And in all the years going back to the 1960s on the silver market, there's only about a dozen times that we've sold off to the degree that we had into the middle of this week. And so with that, coupled with the U.S. dollar being up around a high, it was just only natural that last night and this morning we've seen this great reversal back. In terms of the metals, ended up with the gold market up $30 on the day, silver up about 30 cents on the day. One of the best moves that we've seen since prices really started to break down.
What do you see for the rest of the metals?
The base metal complex has been testing support areas. So you look at the copper price, flirting with that $3 range for the better part of the last few weeks, and it's got some very good resistance levels up around 315 or so. I think that if we can get through this seasonal period right now and start to show some strength through 315, you might want to jump on top of that and go with it. If we take a look at the producers of the other basic metals producers, they've also had what I would call a capitulation type of bottom here into October, in the early part of November. They're probably due for a decent bounce.
Do you think oil will pick up in the new year?
This is another one where we've got patterns that have jumped out that we don't see that often. The weekly charts on crude oil are into a mode similar to what we saw at the last 2 or 3 months of 2008, when we went through that free fall from 145 down to sub 40. It usually takes the better part here of a month and a half to base out once you get these type of oversold readings on the weekly chart. So I think that crude oil is going to try and bottom out in here. We've had support at 80, which we bounced from. Now we're back underneath 80. I would think that there's more time needed before you can develop a lasting base in the oil market.
Ross, how do people get a hold of you if they need investment advice?
Well, they can contact me directly by phone in Vancouver at 604-661-7759, or the toll-free number here is 1-877-331-5122.
Thank you very much, Ross, for being on This Week in Money.
As always, happy to be there.
Coming up, John Kaiser on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is John Kaiser from Kaiser Research. He's on the line with us from San Francisco. John, welcome to This Week in Money.
Jim, it's a pleasure to be on the air with you.
John, Vancouver is usually considered the junior mining capital of the world, and right now the junior mining market is in trouble. Can you tell us what sort of trouble the juniors are having right now?
Well, we're in the 4th year of a resource sector bear market, and now even the energy stocks have been pulled into a bear market with the 25% decline we've seen in the oil price in the past 3 months. Funding has dried up substantially. Half the juniors that are in the resource sector have about $1.8 billion in negative working capital that is probably never going to be paid back, and the other half have about $2.4 billion working capital left, and they are hoarding it because it's become very difficult to get any bump on the upside when you put out exploration results, and makes it very difficult to replace the capital. So we are in a funding crisis that is stopping things from happening.
Do you have any idea what kind of numbers we're looking at when it comes to all these companies struggling?
Well, about 60% of the companies of both TSX and TSX Venture are trading below a dime. Many companies have done stock rollbacks where you, for example, get 1 share for every 10 prior shares. The market capitalizations of companies have collapsed to less than $1 million. When you consider how much money it takes to generate an exploration play and do work on it and then follow it up, the market caps of companies, if they are to raise, are so low that if they are to raise any money, will inflict massive dilution at the current prices that we are at right now.
Is the Canadian junior market, or the venture markets, are they in danger of extinction because of these low levels?
I think that there is a because we are in a cyclical downturn that may take several more years for the drivers of the past years, namely strong metal prices both in the precious and base metal sectors, to turn up again, the flow of institutional money that was coming in has slowed down dramatically. We are in a type of market where the discovery exploration should be making a comeback, but discovery exploration has been the domain of retail investors in the past, and unfortunately there are structural changes to the industry that have caused the disappearance of the retail investor. So we have a situation where nobody's interested in the advanced companies because metal prices are weak at the moment, and there is no money going into the juniors that are doing exploration that could generate a discovery that works at the prevailing prices. And without a discovery to inspire the audience that yes, wonderful things can still happen in this junior sector, we really have a situation where the sector could wither away. And given its poor demographics in terms of the age of the technical people that are in the mining and exploration sector, we could see a retirement binge happen with the technical people just simply not being around 2-4 years from now when one could expect a cyclical upturn to happen again.
What about the people who tell these junior companies, just suck it up, things will get better?
Well, that's what they've said for the past few years, but they are not getting better. We have an end to quantitative easing. We have now the tricky situation where can the United States economy start growing organically without the help of quantitative easing? We have a situation where we do not have the Democrats in control of anything meaningful anymore, so that the sort of Keynesian fiscal stimulus that is needed for stuff like infrastructure renewal will probably not happen for a couple of years. And the concern is if the projected 2.5% growth for America continues right now, this will harm the emerging markets. It's not enough to keep them growing, so we see potential global slowdown, and Europe still limping along too. China has its own problems, so this could mean sagging demand in raw materials over the next couple of years, which, given the pretty good supply response by the mining industry in the past decade, means that we're going to see weak metal prices. So, yes, it is cyclical, but it may be at a cyclical low longer than this sector can survive without some other changes.
Right, because on the equity markets, their cycle has continued 2 years beyond what is normally considered a 4-year cycle. These cycles keep showing up. Is there any way that you can counter that?
Well, I assume you're referring to the Dow Jones and the S&P
right.
companies, the senior companies. They have benefited from quantitative easing, which has taken $2 trillion worth of bonds out of the market, replaced it with cash, which has been recycled into equities. And the companies, because they do not see Main Street demand growing, with wages pretty much going flat for the last 10 years, they have been reluctant to do any sort of productive capacity expansion in the United States. They have preferred to sit on their cash or use it to buy back their own stock, helping prop up the market. So we've had an artificial boom in the stock market, and one of the concerns is that the artificial nature of this after the end of quantitative easing will result in a substantial market meltdown. And that, of course, will really create bad conditions for the mining sector, and in particular the junior sectors, because it would then postpone quite far into the future a cyclical upturn.
Metal prices are still relatively high compared to what they were a decade ago. Why is the outlook for commodities just so poor?
The mining sector has suffered cost escalation substantially higher than the general inflation we've seen around the world. In the United States, it's about 1.6%. In Europe, it's actually negative 0.3%. So in terms of general goods and services, we have had very low inflation, which of course has been bad news for the gold bug narrative, which has been predicting hyperinflation and fiat currency debasement. But within the mining sector, which is quite intensive for raw materials, which have gone up, it has suffered 10% cost escalation in the past 4 to 5 years, and this has clawed back a lot of the nominal, the real gains that were behind these substantial nominal price gains. As an example, gold, the all-in average cost in the world is somewhere like between $12.50 to $13.50 right now. And with gold here at $11.40, $11.50, companies are not recovering their capex by being in production. And even if you take $400 gold from 1980 and inflation adjusted to the present, the number is $11.20. So we have a situation where the huge price gains we saw in real terms are a wash, and that has really hurt the sector.
The midterm elections, as expected, put Republicans in the majority in both the House and the Senate, yet you still have a Democrat president. How is this going to affect gold prices and other factors in the market?
Well, gold prices, I think, will be weak for several reasons. One, there's a risk that the Republicans push for the type of austerity policies that discourage economic growth, or at least push the so-called trickle-down effect way into the future, well beyond it is very helpful. On the other hand, the Republicans are looking very forward to 2016, may marginalize the Tea Party influence and go back to a more pragmatic approach where they negotiate with the Democrats to get measures passed which allow this economy post-quantitative easing to get some significant traction and perhaps get better growth than this 2.5% that's happening. Unfortunately for the gold bugs, what this means is that interest rates will rise, which means, of course, that the relative desirability of owning gold, which yields nothing, diminishes. So we have a scenario here where almost an either outcome, either a deflationary negative situation or a positive American expansion is in the short-term negative for gold. I believe that if we get the better scenario where America grows better than expected, that will help the rest of the global economies get back on track, and that will increase the overall prosperity of the world, which in my view is bullish for gold demand. But right now there's a sense that America is recovering, but the rest of the world is fading, and that's negative for gold.
More with John Kaiser next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're talking to John Kaiser from KaiserResearch.com. What about the security for these juniors and for other markets? And is there any way that you can change the picture? I mean, we're taking a look with a slowdown in China, major slowdown in Europe. Who is going to buy these commodities?
Well, what we usually see in a situation like this, where obviously the companies with the lowest operating cost per unit, they will continue to produce. The iron sector is a classic example. We literally see a war going on between basically Rio Tinto, BH Billiton on Valley with their very large deposits, very low costs. They are not slowing down output, even though Chinese demand for steel and thus iron is starting to decline, or at least stop growing as fast as it has been. And their goal is to marginalize and destroy all the emerging iron operations in Africa and in other parts of the world that needed $100 a ton iron. So you get into a kind of a war, the survival of the strongest with the lowest cost. And what happens then is other parties go in there and scoop up assets where the company has gone bankrupt because they cannot even make money just operating. They cannot recover their capital cost. And what we're seeing is these companies bought at a fraction of their capital cost, and then the assets inventoried until we get that cyclical upturn in metal prices that enables them to put these assets back into production.
Zinc, tungsten, and rare earths, where are they in the markets, and are they a good place to go to right now?
Now these groups of metals are in a category where production is concentrated in in a small number of jurisdictions. We had the big rare earth boom in the last 4 years because China produced over 95% of rare earths and decided to curtail supply, which created a squeeze amongst the end users, and we saw the prices soar. However, the rare earth industry has responded, or the end users have responded by substitution and by thrifting, using less of the rare earth in the application and still getting the same functionality. So we have seen rare earth prices collapse back to levels that were just maybe 50% higher than what they started at in 2009. Zinc is an interesting metal because China has doubled its output in the last decade. And the assumption has always been that zinc demand, when zinc prices go up, the Chinese will simply accommodate by producing more. But that may be about to change because I think China is approaching its own depletion, and with silver prices as low as they are, many of these deposits that the Chinese mine on a very small scale have a significant silver component, and it's ironically zinc that is the byproduct. So those mines may shut down. Plus, the Chinese are getting serious about cracking down on pollution, and a lot of the heavy metals that are in their water supply come from zinc mines. But the other part of the big story is that in the West, more zinc mines are shutting down over the next few years than are coming on stream. So we have a potential double whammy where China's ability to respond to growing zinc demand is limited, and the West's ability to maintain their current supply does not exist. So we have a bull market facing zinc. And in the case of tungsten, it's a metal where, again, China dominates, 85% of output, also small-scale operations, similar type of reasoning as I've just applied to zinc. And tungsten is a critical metal in a lot of applications. Here's where geopolitical issues, such as, say, China deciding that it really wants to become more aggressive in the South China Sea, or even annex Taiwan, developments like that, which could happen in a period where China is suffering internal economic stress, that could disrupt the supply of these metals and create a scramble elsewhere in the world for, say, tungsten supply.
Of course, the U.S. government is dedicated and committed to defending Taiwan. Do you believe a war could break out there?
The question is, would the United States go to war if China, with its historical claim that Taiwan is properly part of itself, decides enough of this nonsense, you are now part of China, will make you a kind of Hong Kong type of zone where we have these sort of bizarre two governments type of situation? And is the United States, with its own deficit problems, going to launch a war over the annexation of Taiwan? Now, China would only do this if it needs a distraction, just like Putin has needed a distraction by annexing Crimea and making an inroads on eastern Ukraine. Who would have expected that a couple years ago? And yet this is happening now, and it's changing the geopolitics, and nobody in the West is particularly eager to rush in and defend the Ukraine from the advances of Russia.
And of course, Hong Kong successfully negotiated its way from Britain into China, although we've seen the demonstrations there where people want democracy to continue. How is this going to affect investment around the world?
Well, even if China does annex Hong Kong, Hong Kong is a major financial center, but it really wouldn't make that much difference. This is really an issue about the Hong Kong people themselves, who are upset that mainland Chinese are literally invading their little community and driving up prices and displacing the native Hong Kong people, because of course it is the wealthy elite of mainland China that is moving into Hong Kong. So what they really want is greater control over the independence of their little mini country relative to mainland China.
John, maybe switch gears here and take a look at the brokerage industry. Why is the shift to fee-based asset management bad news for the resource industry?
The deregulation of commissions made the ability to get your traditional 3% on every trade as your financial model. It wiped out that model, and this happened over 15 years ago. And over time, especially now with this demographic shift of the boomers into retirement age, the idea of conservatively managing people's money has captured the imagination of the banks, and they want the money of clients parked in these 2% value per year and 20% of any gains type of accounts. And they have developed this client relationship model whereby they profile the client's needs and expectations, and then they design a portfolio for that. They discourage stock picking, individual stock buying by these clients. And what has happened is the juniors, which are by definition very high risk companies, they are not part of this equation. And as the companies brokerage firms that used to be specialist firms catering to the juniors gradually get absorbed, the number of brokerage companies that deal with the juniors and deal with clients is diminishing. But even those that continue to want to deal with clients are coming under siege from these suitability rules, whereby at any point, if a broker recommends a stock or even lets a client buy a stock that the client made of his or her own choice, and it goes wrong, the legal system has been designed to allow that client to sue that broker for allowing him to make an unsuitable investment. So there is this litigation mitigation attitude out there that forces these companies to shun these juniors. So the juniors are more and more on their own and have a very difficult time finding investors and getting their capital into their treasuries.
What's your feeling about the uptick rule?
Well, one of the problems that has emerged is that the accredited investor, in other words, somebody who's worth $1 million or more net worth, not including the equity in their principal residence, these investors played a very important role in the last decade by participating in private placements, which would have a 4-month hold. And the specialist brokers would, find these companies that they liked and line up these sophisticated investors and do these private placements. And the whole story behind this was that when the 4-month hold ended, then the sophisticated investor would typically start to sell that stock, ideally at least at the same price that they paid, and clip the warrant, which was typically good for 2 years, as an option on the fundamental success. And this worked as long as there were retail investors coming into the market. Perhaps they heard some newsletter writers say something, or they read an article in a magazine, or they saw some at a conference talk to a company and got excited by the story. And it was basically retail coming in, buying from sophisticated investors who recycled the money by putting at least some of it back into the juniors. And this was an ecosystem that worked very well. But changes such as elimination of the uptick rule, the enablement of algorithmic trading, hooking up computerized trading to the stock exchange, and the emergence of a proprietary trading culture created new selling competition where traders looked for inflows of retail capital money and intercepted it before the sophisticated investors could intercept it. And by being able to sell on a downtick, short stock they didn't have, they created a downward skew in the market, which, given that juniors do not have intrinsic value in forms of revenues and cash flow and so on, it pretty much destroyed any sort of valuation basis and created a bias to the downside. And this has now discouraged the sophisticated investors from putting up private placement money, because an investment in a junior is now a lottery ticket, and we know that if there's no real speculation cycle with an aftermarket of retail investors, that lottery ticket expires usually worthless, because the super success that's a no-brainer, those are quite rare.
What needs to be done to make it a lot fairer playing field for the junior mining stocks?
Well, I think the problem out there is that the retail investor does not really understand the junior sector. The old timers, the boomers, they are retiring. Yes, they have the knowledge, but they have become more risk averse. A younger audience, the younger generation, they have no way of figuring out. There's no broker they can talk to or learn to do this. They are pretty much stuck going to a discount broker. And if they want to just do volatility trading, there are many other options out there, such as ETFs and so on, where they can try to be on the right side of a security swing. So what I think needs to happen is the means by which capital goes into treasuries needs to be improved, and the means by which the audience learns about the mining sector and is able to understand what specific projects are all about, this needs to change. And what can be done in the first case is they need to eliminate the accredited investor rule, which says you have to be worth $1 million to participate in a private placement. This is absolute nonsense, because that same retail investor, that say 30-year-old, can take all his or her savings, put it into a discount brokerage account, and buy as many shares of a publicly traded and fully regulated company as they wish, but they cannot put that same $10,000 into the treasury of that company so that the company has money to drill that project where the investor thinks this could turn into a world-class discovery. And with institutional capital not interested in this sector now and never interested in exploration plays, we have a problem, because the fuel needed to generate discoveries is not going into the tanks of these juniors. And the other thing that needs to happen is the mining exploration sector needs to catch up to the 21st century and create a graphical interface that really allows the public to understand what these plays are about. And I'll give you an example. In the United States, Silicon Valley boys are bugging the various state legislators to allow them to construct a gambling overlay for Farmville, which is a virtual reality game that even kids play, where you have farms and you have crops and they have cycles and so on. They want to bet on the outcomes of this. And of course, what we have here is we have the stock exchange to facilitate trading. We have the regulatory system to ensure fairness of disclosure. And we have the juniors doing real stuff to create real wealth. But what we do not have is a graphical interface that allows people to really understand what it is that the junior is doing and what the outcome might be if it all works out.
John, before we go, could you maybe tell us a bit about KaiserResearch.com?
Kaiser Research is an information portal which focuses on the Canadian listed resource sector companies. We cover all of them, 1,700 right now. We have a search engine which allows you to find a gold company in a certain part of the world with enough money in the treasury based on whatever you believe your parameters are. And we also try to provide commentaries of what our favorite picks amongst this whole group are.
And how can our listeners find out more for themselves?
Just go to KaiserResearch.com. There's a variety of links there that allow you to see which items are unrestricted. And if you're willing to take the plunge for a $100 trial, you get full access to the entire system for 30 days.
John, thanks a lot for being on This Week in Money.
Thank you, Jim.
After the break, Mike Swanson on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Mike Swanson, founder of WallStreetWindow.com. He's speaking to us from Danville, Virginia. Welcome to This Week in Money, Mike.
Oh, it's good to talk with you.
I noticed in your newsletter that you've made a significant change in your portfolio. What's the change and why did you do it?
Well, I really, it's a short-term thing. I've been holding gold stocks, mining investments all year long, with the expectation that they're going to break out into new bull market. And, you know, I sold out the other week and but it's really a short-term move. And of course, everything is dumped since then. But I'm simply just getting ready to reposition and buy back in. So I don't know if it's something most people listening should really worry about. But I'm looking to do more buying over the next couple of weeks or by the end of the year in some select mining stocks.
What kind of mining stocks?
Well, I'm actually looking to buy ones that this is what's one of the things going on now with mining companies is the price of gold has dropped below $1,200 an ounce. I think it'll be back up, but that puts pressure on some mining companies that have higher costs. They're not able to produce at a profit at the moment. For example, Harmony Gold is a company in that situation. And that's put tremendous pressure on stocks like that, which of course has spread over into the entire sector. And people are simply afraid, I think irrationally, but they're afraid that many mining companies are going to go bankrupt, or they're pricing the stocks as if that's going to be the case. And when you see that kind of thing in a sector, that's usually a sign. Sentiment is so bearish, it's almost crazy. We saw that happen in shipping stocks in 2012. The costs that they were getting paid for shipping goods had really dropped real sharply, and the entire sector was being priced as if it was going to cease to exist. And of course, people are still shipping goods across the ocean, and just as right now, some of these mining companies are priced as if they're going to go bankrupt, but mining production is not going to stop. But what I'm interested is finding stocks that have low production costs or future revenue growth coming because they have low-cost mines that they plan on bringing into production, and have stocks that are priced at a significant discount to their earnings and their valuation. And that, I think, presents an opportunity that really wasn't there just a few months ago. I mean, it's really an unexpected opportunity. So while people invested in these stocks have certainly suffered, the past few months, on the other hand, it is an incredible opportunity to buy bargains and create a shopping list. So that's what I'm really working on doing. And so I liquidated many of the stocks, and I did it at Harmony Gold, and that was one that I sold with the idea that, look, I'm just going to clear the deck, and I actually have a chance to buy better things, at incredible discounts.
The major equity markets hit new highs, gold, silver, and industrials taking a plunge. Do you see any buying or selling panic taking place right now?
Oh, we've indeed, had a selling panic. There's no doubt about that, in commodities and in mining stocks, over the course of the past month. When the HUI fell to about 190, 200, it was a significant drop from the high, but it wasn't really a giant panic until we breached those lows, and it just really plunged. I mean, the HUI mining stock index was down roughly 10% 2 days in a row, and that's a significant drop. Now, what's interesting, it's not fun to see that, if you're in it, or whatever, but what's interesting about that is that drop has come 3 years since the high of 2011. And when a market is bearish or negative or whatever for that amount of time and then has a real big panic, that's usually a final bottom in a bear market or the start of a new bull market. So if you think back to the United States stock market, which people are really familiar with, that happened in March of 2009. We had the crash of 2008, and then a false rally in the end of that year, and then another collapse that was at a rate of about 20% over 4 weeks in March 2009. That was the ultimate bottom. In the summer of 2002, in July, there was also a sizable drop in the space of 4 weeks. The shipping stocks, which mentioned before, did that in 2012. But so did European markets, Greek stock market, and I think that's a good way to think about it. If you think about Greece, all the news was negative there. It's still negative, but it was in a very wildly vicious bear market that actually ended in 2012 with a crash of back-to-back 10% down days, and most European markets did that too. And what that bottom did was cause valuations for stocks just to be so ridiculously cheap that it practically didn't even matter what the economy would do from then on. For example, I bought a stock called HL Toy, Hellenic Telecom, which is the biggest telecom utility company in Greece. And I don't own it now, but I bought it in 2012, and it was trading at a PE of 3, and the earnings were fine. The company, the people in Greece did not stop using electrical power. They did not stop using their telephones. And the wild crash in that bear market created opportunities like that. That stock went from like 50 cents to $8 or so. So that's what happens in these collapses, is you get crazy bargains and people price things at very strange levels. Just as in bull markets, stocks like Yelp in the United States, has a PE over 1,000 and cyclically, a PEG ratio of like 8 or something. It's totally insane how some of the stocks in the United States stock market are priced at bubble valuations. That's what happens when you're in a 5-year-long bull market, and when you have these bear markets and then a crash at the end of them, you get the opposite situation. When people have to wonder what kind of investor do they want to be? Not to say one is right, one is wrong, but they have to understand what they're doing. Do they want to be an investor that buys into highly priced stocks and chases and follows the herd? Money can be made doing that if you understand that you're just a herd person and you've got to have some method to get out, or you'll be smashed when the herd runs for the exit. If you want to be a real investor, then you have to take advantage of panics and crashes, and the hard part of that is, you're buying sometimes when it isn't the bottom and things can go a little bit lower. So you have to give yourself room and, be able to manage that sort of situation.
What kind of markers are you looking for to take advantage of the equity markets?
Well, honestly, I'm more interested in investing where the valuations are cheap. So I'm more interested in the mining sector. But when it comes to the stock market, I actually think it could top out sometime over the next couple months or go into a bear market. And if I think that's going to be the case, or I start to see signs of that, I'm looking to take advantage of that by shorting it.
In your recent newsletter, Wall Street Window, you mentioned a lot of investors have tunnel vision. What is it, and what are the dangers?
Well, what I meant by that is most people they simply invest in one market and have one viewpoint of that market almost their entire life and think that's what investing is. For example, someone investing in the United States, most Americans just put their money in mutual funds and just hope it goes up forever. Other people, can do the same thing with the mining stocks or commodities and think, well, I'm just going to invest in this forever and forget everything else. And what ends up happening is if you only trade one market your whole life and have one viewpoint about it, you just miss out on everything going on, and you miss important market turning points in that market, and you end up just making a lot of money in the bull markets, then getting wiped out when the bear markets come. And it's a very difficult way to do things, but that's really what most people do. They just have one market and one view, and they just look for confirmation of that all the time and ride this big boom bust cycle over and over and over again.
How can people find out more about your articles in your e-letter?
Yeah, thanks for asking. They just go to wallstreetwindow.com. It's all one word, Wall Street Window, and there's blog posts they can, read if they like. And if they really want more, they should subscribe to the newsletter. There's a free email newsletter of, I send out something about twice a week with information.
Mike, thanks a lot for chatting with us on This Week in Money.
Thank you.
That wraps up our show for this week. Thanks to our guests, Ross Clark, John Kaiser, and Mike Swanson. And thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.